We'll copy Tesla and then we'll be like Tesla. And our stock price will be like Tesla. There's only one Tesla, right? It's proven that every other direct-to-sales model so far is failing. Rivian's losing gobs of money on every unit it sells. Fisker come and gone. Lucid, is it still really out there? So I feel like this is a big mistake.
Today, I'm thrilled to welcome back Alan Haig, president of Haig Partners, a leading dealership buy-sell advisory firm. Alan shares his insights on the post-election landscape in automotive and how the new administration could impact the car market and dealerships in 2025, from the potential upsides to the challenges ahead. A big thank you to our sponsors for making today's episode possible: OpenLane, Impel, and Haig Partners. And now, let's get into the show. Alan Haig back on the CDG podcast for another M&A update. Alan, what is going on?
Good to be with you again, Yossi. There's a lot going on.
I know. Alan, I don't even want to talk about any M&A stuff yet. What's new? Just tell me, what is new in your world? You talk to so many people in our industry. You see a lot. We're coming off, a big elections for the country, which is, going to likely have, lots of impact on our industry over the next 4 years. What's new in your world?
Well, you mentioned the election. I would say that is having a lot of people spin their wheels in terms of what's the impact going to be on business if I want to sell it, or what's the price of a business if I want to buy it. And I think people are still processing the results and what it means. But, we have some of our friends that are dealing with FTC lawsuits where they've had to sell stores to reach a settlement. The public companies are being sued for FTC for all types of things. So I feel like some of the attacks that our clients and our friends are feeling may go away, which will feel good. And then we've also been pretty worried about our dealer friends that own stores in CARB states, where the requirements to sell a majority EVs here coming up pretty soon. I think they're also hopeful that those requirements are going to be reduced so that there can be a better match between the products available to consumers and what consumers want to buy. So for instance, we're selling one heavy truck group right now, and it's in a CARB state, and the supplier there is Freightliner. And Freightliner said, you have to sell one electric truck, and every time you sell one, we'll give you 7 diesel trucks. And the problem is that the electric trucks are 3 times the price, have half the range, like 5.5 hours to charge. So there's no demand for those trucks. And so our client was concerned that truck sales would go to zero here in that state in a little bit. And I know a lot of dealers in California are wondering if I'm a Ford dealer or Chevy dealer, a lot of my vehicle sales or trucks, California is going to make me sell EVs. We know the demand for EV trucks is very low. So I think that for a lot of people, there were mixed feelings about the results of the motion. But for people who own auto or truck dealerships, I think they're feeling pretty good. I spoke with one gentleman today who's interested in buying stores. His concern was that this election is going to result in the value of stores going up. He's going to have to pay more. And of course, that made me smile, because that's what we get paid on. Is the value of stores.
Yeah. Wait, so what was the logic there? Right. So I'm specifically, is he correlating it with lower rates or just a hotter economy, which, juices profits? Did he get specific?
I think he just felt that car dealers in general would feel better about the future because they would have maybe lower gas prices. Maybe there'd be lower taxes. Maybe there'd be fewer regulations, fewer lawsuits. So in general, those are things that dealers like to hear. Now, of course, there's also discussion of tariffs, right? So if there are tariffs that go on imported vehicles, the cost of the vehicles go up, sales go down. But it's not all positive outcome for our industry. There are going to be some positive, negative influences. But I would say that has a lot of people, thinking about, gee, what just happened? How's that going to impact me if I want to sell? How's it going to impact me if I want to buy? And right now, I think in general, it should stimulate the demand for dealerships because some of the risks just went away. It's going to absolutely lift the value of stores in CARB states, in my opinion, because those dealers should be able to project that their sales will continue at or near current rates. But as to what happens with tariffs and the other things that are going to come with the new administration, nobody's sure.
Yeah, it's definitely a big wild card. What do you think about, it's interesting. We have Elon Musk so involved in this new administration. It's never happened before to someone that is directly running a auto manufacturer and retailer. Undoubtedly will have impacts on many things. But what do you think about EVs, their impact on dealerships and dealership valuations? Do you have any perspective on how just the EV trend is going to continue impacting dealership valuations in general?
I think for certain franchises, it's absolutely been a negative. If you talk to our friends that have Mercedes stores, they were forced to buy a lot of vehicles that consumers just didn't want to purchase. And that's cost them a lot of money in terms of dropping prices to sell them, the advertising, the compensation to pay salespeople, the floor plan expense they had to pay for these vehicles before they were sold. So certain brands, it's been a big negative on their profitability. And I think the same has been true with Ford dealers. Most Ford dealers are selling Mustangs or Lightnings at a loss. So it's not been a good outcome so far for dealers. Now, Hyundai and Kia are selling a decent number of EVs. Those products have been relatively popular, but they're not big winners for dealers either. So I think in general, dealers want to sell what consumers want to purchase. So if the demand were there for a lot of EVs, dealers would be happy to sell them. Um, the result in the service department has not been what's been feared. People are afraid, like, hey, you sell an EV, it's not going to require any service. The reality is, I think so far there's some studies saying that the repair costs in EVs has been higher when you include recalls than on ICE engines. Maybe it's newer technology, et cetera. And people were afraid that if you bought an EV, you'd never bring it back to the service drive. And I think they're discovering that people are more likely to bring an EV back after it gets out of warranty than an ICE car, where there are more people that can repair it. So dealers want to sell what customers want to buy. The part where there's inefficiency and friction is when the government's trying to force you to sell a product that the customer doesn't want to buy. And you got the government who's providing massive incentives to purchase these. You have the factories that are spending billions of dollars to try to build these things and promote them. And you got the dealers that are doing their part in terms of cutting prices and putting incentives out there to sell them too. And the customers are saying, we don't really want these. So it's just been, we try to force something that's the market's not yet ready for. And I think that's part of what I believe the new administration will see, because Mr. Musk is going to be in there whispering in President Trump's ear. And of course, Musk sells EVs. So the outcome may be different than what a lot of dealers are expecting in terms of reducing the requirements of EVs. We'll see.
Well, yeah, you also mentioned the FTC. I have to imagine, you know, some significant changes to our government agencies if, these changes really come to fruition, which seems to be the intent here. So,
All industries need some regulation to make sure that there's a fair playing field for consumers, right? We shouldn't have industries that are out there abusing consumers. And I believe that auto dealers, for the most part, bend over backwards to disclose things to the consumer so there's no surprises, because they want that customer to come back to them for many purchases in the future. They don't want to burn somebody and just get one sale and lose the customer forever. So the dealers that I've spoken to believe this FTC is extremely aggressive. They're targeting not just the company, but the senior executives personally. That's not common, and to my knowledge, in terms of this type of government regulation of an industry. So I do feel like that will diminish, if not go away. And then also there have been a number of CFPB, CPFB. I get the acronym confused.
CFPB,
CFPB,
Consumer Financial Protection Bureau.
Protection Bureau, yeah, where they feel like there are no consumers really being harmed, and yet the bureau is out there trying to find something to hit dealers about. So I think there's hope that the regulatory burden, the attacks will diminish under the administration and won't interfere in the relationship between the dealer and his customer.
I learned a little too much about the CFPB when I hired someone that worked at Drive Time at my old company. So they knew a lot about the CFPB. I didn't even know the acronym before that, but they taught me a lot about that.
That business has to charge 30% interest rates probably to break
Yeah,
even. So he needs to do
that was well. I mean, it really was the first time I even acknowledged the CFPB. Um, so Alan, like one of the reasons this is one of our most anticipated episodes, when you come on, for dealers is because of, we really dissect the Haig report. So, and I also want to wish you congrats. I know it's the 10th anniversary of the Haig report. So that's truly a remarkable feat, simply because you really are able to distill insights from the industry into this report of what is really going on the ground floor. Fun fact, we also put out a remarkable image that your team sent us. I think it was maybe a month ago, maybe the last couple of weeks ago. But it shows the dealership valuations. We put it on social so anyone can see it. But it showed dealership valuations, how they trended over the last like decade or so, maybe 2 decades. And it was pretty incredible. You see how different brands have, risen, fallen, shifted. But great graphic. We'll actually link it in the show notes below as well for anyone that wants to check it out. Of course, we link your Haig report in the show notes every time. Looping back to my initial thought, would love for you to give us an overview of, the Haig report that you just released, right? What is happening right now in the automotive industry, specifically when it pertains to mergers and acquisitions?
So in our report, we start with a lot of macroeconomic data, which in general is very positive, right? We have a growing economy, GDP is positive. We have low inflation. We're back almost to the 2% that the Fed wants. We have low unemployment. We're below 4%. We have declining interest rates. Gas prices are relatively low. So there's a lot of very positive features in our economy today. And then we go into what's happening to auto dealers today in terms of the performance of their stores. And we track the public company results that come out every quarter in terms of profits per vehicle, dealership profits, et cetera. And that data is 100% accurate, right? This is information coming from the public companies. It's been scrubbed. It's been audited. It's correct. Most dealer statements that I see are coming from private guys that they're almost never correct. They're never accurate. Not all of the expenses are reflected. Not all of the income is reflected. So it requires a lot of manipulation. So the latest information from the public show that we continue to see a decline in new vehicle gross profits. They're down 27% from where they were a year ago. But the decline is starting to level off. And we're watching that very closely because a lot of the profitability of dealerships is driven by this high value we're seeing currently of gross profits per new vehicle. Used profits, we're back to where we were in 2019. It's kind of amazing to me given the lack of new vehicles in the market, but we're right back to where we were in 2019. F&I has leveled off. Gross profits per vehicle have leveled off. For a while, we saw them declining a little bit as consumers began to balk at buying more product because the value of vehicles had gone up so much, interest rates were high, that their monthly payment was becoming unaffordable. So they started to not buy the tire and wheel or the service contract. That's now stabilized. Fixed operations are still growing. They grew 4% in the quarter compared to last year. So these vehicles either continue to break, recall activity is still really high, but also dealers have responded to the lack of trained technicians by raising their labor rates. And we see labor rates in some parts of the country. I live here in South Florida. A number of our friends are charging over $300 an hour for their labor because that's what customers are paying, so they can charge that to the factories as well. So when you combine new, used, F&I, fixed, and the expense side, we see profits per dealerships now have come down from where they were. And the last, we take the first 9 months of this year and annualize it, average profits per store are at $4 million for the public companies. That compares to $2 million before the pandemic. So average profits per store are still double where they were. So we're still in a really good time in general. But then, no one has an average store. So you either have a Toyota store or a Nissan store or, whatever your franchise or a group. So when we talk about averages, that's interesting in talking about generalities. But there have been massive changes in the last year in terms of performance by franchises. And we've all been, watching the decline in sales at Stellantis. We've all been watching the decline in sales at Nissan and Infiniti. And those declines in sales are having a massive impact in the performance of those stores in terms of the bottom line. So Toyota Lexus stores are doing great. They barely dropped profits at all since the pandemic. They're not down 27%. But Stellantis stores have gone all the way back to where they were in 2019 or further. A lot of them now are not making any money at all. And, we have this phrase that it's not my phrase. I heard it from Warren Buffett. He said it many years ago during the Great Recession, which is now 15 years ago. But his phrase was, when the tide goes out, you can see who's been swimming naked. And I think we're seeing some franchisors and some franchisees, some dealers who were able to make a lot of money during the pandemic when supply was limited. So customers would come and buy cars from you because you had them, and they would pay you what you wanted because no one else had them either. So it was quite easy to make a lot of money during the pandemic. Now we're going back to the part where you have to be a good retailer. You have to take good customer care of the customer. You have to watch your expenses in terms of the level of inventory, the level of advertising, the level of compensation. My former boss and mentor, Mike Maroney, said, you got to control the controllables. And those are the three biggest controllables. And so I think for a lot of dealers during the pandemic, maybe they grew a lot. Maybe some of their management teams took their eyes off the ball, but they've seen really high profits evaporate within a quick amount of time. And so in the M&A market, what that means is that, earlier this year, we were selling dealerships for record high prices. We had the pleasure of selling some dealerships here in South Florida, BMW and Honda, for the most anyone's ever paid for those franchises. There's another owner of some Mercedes stores here in South Florida. Two stores, sold for, I think it was $430 million in Blue Sky. So just, 430 million. Yes, just massive amount of value earlier this year. Now a lot of our work is shifted towards divestitures. And we're divesting some good franchises for dealer groups, Hondas and Toyotas and BMW and Mercedes stores. But we're also in market with a lot of Nissans and Stellantis stores where people have said, hey, I'm tired of losing $150,000 a month or more. I need to sell this dealership. And by selling it, they can extract the value of their real estate, the value of their working capital, the value of their inventory, and they can turn a money loser into a positive source of cash.
This episode is brought to you by OpenLane, the leading online dealer marketplace for used cars. OpenLane brings more than 25 years of innovation to the wholesale automotive industry, solely focused on making wholesale easy so dealers can be more successful. Their marketplace offers a fast and transparent way to source used and fresh vehicle inventory. Looking to sell? On OpenLane, you can turn vehicles into more cash fast. With a nationwide network of buyers, vehicles listed on OpenLane sell in less than a day on average. OpenLane is the industry leader in innovation, rolling out new tools to make buying and selling easier. Visual Boost AI leverages the power of AI to help buyers review vehicles quickly and bid with confidence. New to OpenLane? Sign up now and new sellers receive a $2,500 sale fee credit. Learn more at openlane.com or click the link in the show notes below. Break that down for me for a second. So I was going to ask you about, what are dealers coming to you with now? And you mentioned some divestitures, Stellantis, Nissan. These stores that you're seeing are losing money, right? Is there like a common theme? Do they have they don't run strong service departments and, weak used cars, or what is it, right? Like, what are you seeing across the board, or maybe like where are the buyers adding value typically, right? Because new is, somewhat out of your control, right? Used, service can be a lot more in your control. So I'm curious, are you seeing any common pattern across the stores? Or, by the way, is it like, I just wrote about what I call pandemic hires, right? Which when you talk to dealers, like, hey, what is, one of the biggest challenges, or at least in the stores with weak management, it's the pandemic hires that don't know that only operated in a, zero interest rate environment. And they're not used to this environment, which really prizes the fundamentals, right? That's been a very weak spot for dealers. When you talk about, who's swimming naked, that's how I perceive it. So anyways, going back to my question, any common themes you're seeing across these stores that are selling, any weaknesses, or potential strengths that, or areas for value add that you're noticing?
Management comes to the top in many ways. I mean, we're doing evaluation on a group of stores this afternoon, and their business includes a Nissan store that's making $2.5 million a year. So there are some businesses that still, even if the weak franchise, are still quite profitable. And I think it's because the operator of that store kept his inventory fresh So if you don't watch your inventories, a lot of bad stuff starts to happen. Because your inventory starts to age. When it gets aged, it's harder to sell. When it's harder to sell, your floor plan expense goes up. Your salespeople begin to lose heart. They start to drift away from you because they have a hard time making a living if your vehicles are priced too high. And then if your sales rate drops, you have fewer chances to buy used cars. So now your used inventory drops. And then the technicians are looking around like, I'm not doing as much work here. There's not reconditioning work. The units in operation is dropping. I'm not doing as much warranty or customer pay. So store begins to cycle down if the new vehicle sales rate drops. And at some point, it drops below the level of profitability, and your fixed and variable expenses exceed your gross profit, and you have a money losing store. And the good news here is that for every one of these money losing stores, there is a home. I mean, I remember this at AutoNation. The last time that I was there, we sold in 4 years, we bought 14 stores and we sold 56. And I started to go to the closings and I started to interview the buyers a little bit. Like, well, what is your plan here? And how are you going to make this profitable? We couldn't, and they had various answers. But I remember this one closing in Michigan, we were selling a Chrysler Jeep store. And he pointed out all the areas where we had kind of given up or tried to save money. He goes, well, the first thing I'm doing is I'm replacing all the light bulbs that burned out in the lot outside. And I'm going to tear out this stained carpet here and put in some fresh carpet. And I'm replacing the ceiling tiles that have roof leak stains. And I'm going to bring in some fresh inventory because what you have here is aged and tired. And I run some big ads. That's when we used to sell cars through newspaper ads. I'm going to put some big ads in the paper here. And I'm bringing, a food truck here on Saturdays, and we're going to get people excited about it. And he brought a fresh level of energy and some new people, and a willingness to invest in the business that we were trying to just staunch the losses. We didn't want to write more checks to fix stuff up. But we see that, where that phrase, one man's trash is another man's treasure. We're absolutely going to see that here. There's going to be an era where, let's say I had, Toyota, BMW, and Lexus, and I've got a Nissan store. I'm not going to give that Nissan store the attention it deserves because I'm going to focus my attention on my stronger brands. I'm going to put my best people at my best stores. And then I kind of give no love to the Nissan store. Well, if there's an independent dealer in town and they're dying to become a franchised operator, Nissan is an affordable franchise for that person today. That dealer is young, resourceful, hungry. They're going to move into that store. They're going to be thrilled to be a Nissan dealer. And they're going to focus on selling more used cars. The techs are busy. The salespeople have something to sell. And they'll wait for Nissan to recover. And I believe Nissan will recover. I've heard some encouraging things from their new management. They seem to get it. He comes from Lexus, which is some good DNA. I think he's been a Nissan before. So he understands the history of what Nissan was. And hopefully it can get back towards where it should be. It shouldn't be where it is now.
Tell us more about just the pulse of demand. What are you getting calls for from buyers right now? Is it for the typical, Toyotas, Lexuses, which are always in demand? Or is it, hey, I'm looking for a deal. Maybe I can find it now with Stellantis, Nissan, or anywhere in between, right? Where's the demand sort of drifting?
So it has changed over the years. I remember before the pandemic hit, I got a call from a very wealthy dealer who said to me, I'll buy a Mercedes store anywhere in the country. Please just bring me a Mercedes store. That was the really hot brand, I would say, 6 years ago. Now that's what I'm hearing with Toyota. I'm reading a social media. Yeah, it's still Toyota is still, and maybe it'll have its time. It'll decline a little bit too, but right now it's in that flight to quality. There are probably more people that would like to own a Toyota store than just about any other franchise. So that's still number one. Like we have two closings coming up later this month. One is for 2 Toyota stores and one's for 1 Toyota store. And I didn't have any sleepless nights worrying about if these deals would close because I think the buyers are very excited to buy them.
Well, also with Toyota, though, the other thing to consider is if EV mandates do go away, or if the electric vehicle tax credits, if the tax credits go away or they become less competitive, Toyota is set to really gain from that with their hybrids, who will now be more competitive. So that's another boon that, the brand may just experience now, which was, had a much lower odds last month than it does now.
Toyota does it again. They have a greater level of foresight, I think, than most factories. Like it never made sense to me that General Motors and Ford said, yes, we'll go to EVs, and you had Jim Farley that broke his company of 3 divisions and volunteered to run the EV division. I wonder if he feels as good about that decision today as he did, a couple of years ago when he started that. But no, I think that's an example of where Toyota. I remember hearing Bob Carter speak a couple of years ago, and says, "We want to be the Macy's of powertrains. You want a V8, we got it. You want a Turbo 6, we got it. You want a Turbo 4, we have it. You want hybrid, you have it. You want EV, you have it. You want plug-in hybrid, we have it. Whatever the customer wants, we're going to have." And that was the correct strategy. And I think that now you see the domestic brands spinning around at launching hybrids. I haven't yet seen a hybrid F-150, but I'm sure it's coming. And I think it'll get good interest because I think there are people that say, I would like to be able to drive 20 or 40 miles on an EV only and then have the gas engine kick in. So I'll have all the range I want, but still be able to save some money on gas or get some additional acceleration when the electric motor kicks in. It's a great technology. So we hear people still want Toyota. I would say recently we've heard people starting asking for Ford stores again, which was off the buyer's list, off the shopping list.
What changed in your opinion? What changed with sentiment?
I think that, the people that have been longtime Ford dealers, and I remember hearing this from Sam Pack, who's a big successful dealer in Dallas. He has some of the largest Ford stores in the country. And, they certainly sell a lot of Fords to regular consumers that use them for getting groceries, taking the kids to school. But a lot of the people that buy Ford are buying Ford trucks, and they're buying them for their professional use. They're contractors. And that vehicle is their business. It's their office. And so I remember asking him, hey, are you worried about autonomous vehicles and EVs? And he just says, nope. And he explained why, because these vehicles they have to operate for them. They have to be cost effective. And so when they break, and they do break after a lot of use, the customers bring it back to the shop and they pay whatever it takes to get it repaired. So where I'm going with this is that I think that Ford has got the best, I'll call it, commercial truck lineup until you get up into the heavy duty stuff, with the 150s, the 250s, the 350s, the diesels, the dualies. I mean, it's almost a commercial truck franchise. And we sell those businesses as well. So we know that the fixed operations are incredible. So I know that a lot of dealers have experienced that too with Ford, was they like that broad Ford truck lineup. It's broader than Stellantis and it's broader than General Motors. So now people are willing to come back into the water. They feel like Ford has maybe realized that EVs are not necessarily the future and will continue to invest in ICE technology. And so the Ford truck franchise is something they want more of.
Tell me more. Are you seeing that when it comes to Ford, are you seeing that people have sort of done away with the prior sentiment, right? All the, saber rattling from Jim Farley, we're going to do this and that. Have dealers just gotten more comfortable with that? Because what you just stated, like, that's been the case for a while, right? But have dealers gotten more comfortable that Ford is not going on some fringe path or something like that?
They absolutely were concerned about that when they saw those announcements, and they were forced to buy these really expensive chargers and reconfigure their dealerships for vehicles that the consumers didn't want to buy. So there was a lot of anger and mistrust of Ford management. But I think that is now lessening because they see Ford taking actions. I think Ford even is paying some people back for the chargers that they installed, giving a little bit of credit back. They're not requiring people to put in these chargers to sell their products anymore. They're launching hybrid trucks as opposed to EV vehicles. And so I think they've seen Ford smell the coffee, whatever the right euphemism is, and responding to market demands, which is what dealers want. That's what dealers want from their franchisors. Build what the customer wants.
This episode is brought to you by Impel. A word of caution to dealers. Open source large language models like GPT are conversation tools, not business solutions. If you want to embrace results and not risk, choose AI that's purpose-built for automotive retail and drives dealer results throughout the entire customer journey, from website to chat to sales to service. Impel AI is custom built to drive dealer business objectives and features a proprietary blend of large language models, automotive optimization layers, and seamless integration with your entire tech stack. The result, exceptional customer service experiences and increased customer lifetime value, and that means more revenue and greater profitability. Embrace results, not risk with Impel AI. Visit impel.ai or click the link in the show notes below to see what the future of AI looks like today.
You know, Alan, you make a really astute point here, because I think dealers are, and the industry in general, is looking for ways to diversify, to hedge, right? Given just all the change that the industry is undergoing, whether it be technological, types of mobility, AVs, EVs. I mean, there's so much change, right? Just the way that a car is purchased nowadays, AI. And I think it's probably under discussed and underappreciated, but what you just said about commercial, vehicles and sales just being a hedge, right? Someone that you sell a commercial vehicle, it's used for work. It's easier for me to go to that shop and to spend the money to repair it, right? Because it is, I'm just less sensitive to that dollar. It's for work. I need it. And so I think you just bring up a really interesting point that I talk a lot about diversification, dealers investing in collision centers, other dealers, horizontally integrating, investing in power sports and stuff like that. This is one that is probably under discussed, actually, just diversifying.
I think maybe if you want to reopen this topic, you could say it's the Ford truck customer is going to have the dealer's going to have greater retention of that customer. Because if that vehicle breaks, maybe it's a diesel powertrain, maybe it's some electronics, the dealer will have the parts and the expertise to restore it quickly. Versus if the customer takes that to a third-party repair shop, it may not be repaired for a while. Maybe he can't access the parts, or maybe he doesn't understand how to repair it. And meanwhile, that contractor is out of business. He can't get to his customers. He can't supervise his employees if his truck is down. So it's not a discretionary spend like, yeah, okay, I'll go ahead and get the tires replaced now. It's a mandatory spend to get his livelihood back. And that's the difference between a Ford dealership and perhaps a Kia dealership, where they might shop around for that repair. They might not do it. They might defer it. No, if your vehicle is down, if it can't tow, if it can't haul, if it's not operating properly, you can't make money.
Yeah. No, I just think it's a really good point. And if you think about the way our industry's trending, again, just think autonomous vehicles, think 10 years out, 15 years out, right? You buy a dealership, it's really, it's an expensive asset. You're not thinking in 2-3 years, you're thinking in, decades in many cases, if not more. And when you think about what vehicle might be, or where will there be the most competition, right? What's going to be the toughest vehicle where margins will erode? It's likely that, entry-level consumer vehicle. And so as you get into the commercial side of things, I think it's a really interesting hedge when you think about just long-term viability of the business.
There's one other aspect too, Yos, which I think is an interesting part about our industry, which is before the recession, there was very low margins on some of the most desirable vehicles. So I remember the Toyota Camry would sell for no profit or less than zero profit, for many dealers, even though lots of people wanted that car. The day supply was very short. Versus an F-150, you could always count on to make $1,500, $2,000 a copy. And I think part of the reason why is that there's so many configurations of a truck: 2-door, 4-door, 2-wheel drive, 4-wheel drive, short bed, long bed, powertrains, all that kind of stuff, that those trucks, even though they make a ton of them, are less commoditized than a sedan, where you have 2 or 3 levels of trim and 2 or 3 colors. So it may be that dealers are thinking, hey, as we get away from the pandemic and supply returns to normal, I can probably still make decent margins on an F-150 and F-250. I'm going to make great margins on the fixed operations. If I sell an F-150, I'm probably going to take a vehicle on a trade. Maybe it's a 6 or 8 year old truck with 150,000 miles. I'll buy that, recondition it, put it on my front line. I'll make another couple $1,000s and selling that vehicle between front end gross and back end gross. So I think that the dealers remember that Ford dealerships are now essentially truck stores, right? There are almost no Ford sedans. I think there's the Mustang, and I can't think of anything else. Everything else is sort of an SUV or a truck. They've given up, and that's been a hard thing for Ford dealers too. Is they've lost maybe 15% of their volume from the pandemic.
Yeah, well, they've also deliberately gone upstream. It's been part of part of their plan. And when I say upstream, I mean all these vehicles are simply more expensive, and they're also working on more customized and whatnot. I want to ask you a related question. You mentioned earlier that Ford had the plan of breaking out into multiple divisions. At a certain point, several years back, they had murmurs of potentially going direct to consumer and whatnot. Volkswagen or Scout was recently announced, right? The return of Scout. We know that it's directly partnered with Volkswagen. I'm not sure exactly the how the corporate structure there works, but it's one of the same. Um, how does this impact the industry, if in any way? I mean, what's your take, right? Like, is this another direct to consumer brand that's a spinoff of a legacy brand? Like, will that work? Will that succeed? Will that impact dealership valuations negatively? What's your take?
I think it's a tremendous mistake. I think it's a mistake for Volkswagen because this is a new product that people haven't seen before. Volkswagen doesn't have 600 locations that it can show this to, except it does. They're called Volkswagen dealerships, and what better way to sell the Scout than to put it out on the front line on the dealer row all the way around the country and have trained salespeople be able to demonstrate that product, to be able to give those customers a trade-in value, to help those customers, test drive it and learn about it. There's no better way, in my opinion, to sell a new vehicle than through an existing dealer network. So I feel like this was a decision that was made 6 years ago, maybe when Tesla was the only person in town doing the direct to sales, and they saw how well Tesla was, and like, well, let's just get some of the Tesla. We'll copy Tesla, and then we'll be like Tesla, and our stock price will be like Tesla. There's only one Tesla, right? It's proven that every other direct to sales model so far is failing. Rivian's losing gobs of money on every unit it sells. Fisker come and gone. Lucid, I mean, is it still really out there? So I feel like this is a big mistake. I feel that Volkswagen has invested billions of dollars into designing this product and invested a massive amount of money in this plant. And I think it's going to be a flop unless they change course, put it into, yeah, I think it's because the market's not asking for $70,000 pickup truck or SUV. We can see it amongst other offerings. People didn't buy the F-150 Lightning. Why are they going to buy the Scout pickup truck?
Well, I think the being devil's advocate here, like it's a more desirable product. That's at least the goal, obviously, that they're striving for.
Maybe Ford has got millions of loyal customers that wouldn't buy another truck other than Ford. Volkswagen has, maybe there's a couple hundred people out there that bought the old Rabbit truck. I remember I had a girlfriend who had one of those Rabbit diesel trucks. There's probably still a few on the road, but they don't have a built-in buyer base of people buying these EVs, And if you look at the Volkswagen dealer network, it needs more volume. It needs some excitement to draw customers to those stores. They've got nice products. The SUVs they have, the Atlas, those are nice cars now. And finally, they've got some good products to sell to customers. But I think many consumers don't consider the Volkswagen brand anymore. They're looking at the Toyotas or the Hondas, or the GM, the Fords. So this Scout could have brought some real excitement back into showrooms. And I think it's a massive loss
That's a great
for the
point.
Volkswagen Corporation. And it also creates a lot of distrust for the dealers. Like, wait a minute, I know you're violating state franchise law. You're not allowed to manufacture the vehicle and sell it. That's a violation of state franchise laws. You know that that's a violation. You're still going to do it. Why would I invest in your franchise? Why would I put my best people in there when you're demonstrating that you're willing to go around me rather than work with me? It's a terrible message. And compare that to what Toyota has done. Historically, they were concerned about their aging customer base. They thought they were becoming the new Buick. So they created Scion to bring in younger customers. They didn't create a separate dealer network for that or go direct. They sold it through existing Toyota dealers. Now that experiment eventually went away because Toyota got better style products. Now they're coming up with a new higher than Lexus model line. And are they going to sell that direct to consumer? Are they going to set up a different dealer network? No, they're going to sell it through Lexus dealers because they believe in partnering with their dealers, not going around them to try to make an extra buck.
Yeah, I mean, it makes you just wonder what would happen to Volkswagen store valuations, right? If this were combined, like how damaging is this in theory to their valuation? And like you said, this could really bring, revitalize what Volkswagen stores in general with this new fresh product, plus, arguably a more capital efficient distribution strategy. Again, Tesla is Tesla. And you have to imagine they're going to have to spend a ton on paid marketing to get the product out there.
So let's compare it to Tesla. This is a good example. So Tesla had the advantage of being the first mover, right? They were the only EV out there. Elon Musk is, whatever you say about him, he's a brilliant guy that was able to produce an amazing car. And now he's producing it for pretty low prices. I mean, Tesla used to be kind of a luxury product. It felt like a economy car on the inside, but it was priced like a luxury car. Now those things are priced like a mass market vehicle.
Extremely affordable.
And that's not where Scout's coming from. Scout's coming in the 50s, 60s, 70s. So they're starting out, in my opinion, above market. And we recently wrote a letter to Elon Musk inviting him to enter the franchise system for a number of reasons. One is his sales have stalled because the early adopters have their vehicles. And there have been a number of studies that show that people talk about wanting to buy cars online, but in the end, they really want to come into the showroom to test the vehicle, to get help with financing, to get somebody to take their trade. They want a dealer to help put together the transaction. So I think that Tesla sales have stalled. They've exhausted the early adapters. To get to the mass market, they need to have a Tesla location on every dealer row, in my opinion. And then secondly, Tesla has something like $9 billion in inventory that they have now in their books. They have to dilute their shareholders by having that capital locked up in inventory versus if they had a dealer network, they'd ship the car, charge the dealer, and get paid for that vehicle versus sticking it out to the dealer's inventory. So there are all kinds of reasons why, also repairs. One reason why people don't buy a Tesla is they know it's going to break. They've read about Consumer Reports. Consumer Reports doesn't even recommend that people purchase this Tesla right now. And so if it does break, they've heard reports that, well, it goes to some service center and stays there for weeks or months because they don't have parts. Versus if there was a Tesla right down the street, a service center owned by a dealer who gets paid to do the repairs, I think they'd have a greater level of confidence in buying the vehicle because they know that you get it serviced more easily. What's going to happen if I buy a Scout and it breaks down and I'm in North Carolina and the closest distribution center is in Atlanta? Are they coming to fix it? Are they sending a truck? Do I have to take it to them? It just creates another barrier to purchase that Volkswagen doesn't need today. And in terms of dealership values for Volkswagen, they're among the very lowest in our industry. And it's not like you could say, hey, Scout is going to lower that more, although I could argue it could because dealers may have less hope. But it's also that the billions of dollars that Volkswagen spent on designing and manufacturing and now marketing that vehicle could have been used to develop market products that would have been sold through Volkswagen stores. So it may not lower them more than where they are right now, but it's not helping them. And that's really what Volkswagen need. They need more product, more competitively priced product, more marketing, more awareness, get people to come in there and try those vehicles. And Scout's just going to dilute Volkswagen's ability to support their existing dealer network.
So, Alan, I want to take us back now to the just industry trends in general and the fact that like record M&A deals are still happening, right? We are several years now post, peak pandemic. Transactions are still happening at a just very rapid clip. Public groups have seemed to tone down a little bit. Private groups are running and gunning. What's happening? Like, what's driving the velocity of deal making in a current market, especially given the fact that, the elections just happened. Like everything I'm referencing has been, prior to that, right? So even more uncertainty in the markets. Like, what has driven the deal making velocity that you've witnessed?
Well, this year, um, we have seen about 389 rooftops trade hands in the United States. That compares to about 450 this time last year. So volume's down about 13%, but we're on track to be, the fourth best year ever. Before the pandemic, there were 300 to 350 stores that trade hands. This year, it looks like we're going to be, in the low fives. So lots of M&A activity. The record high values were set early this year because there were record earnings. So people were paying on profits that were very, very high. Now, we track dealership values pretty carefully. Before the pandemic, the average dealership might be worth kind of 10 million in that range. It went up to about 25, 26. It's down now about 21. So it's come down, but it's still double the values of where we were before the pandemic. We sold a Kia store when the really big numbers happened in the end of 23, beginning of 24, because that's where we still had massive profits and buyers had massive amounts of cash. That's another part of the equation, right? The earnings were high, but also dealer groups have been generating so much extra profit, well in excess of what they could use to improve their facilities or pay down their floor plan or their mortgage or whatever. They had all this cash. What are we going to do with it? Buy more stores. So the demand was high when the earnings were high. That's a recipe for high prices. Now we're seeing the earnings come down, and we're seeing that a lot of the acquirers have burned through some of the excessive, I don't want to say excessive, but amazing amounts of cash that they accumulated during the pandemic. And now they're faced with, hey, if I do an acquisition, I'm going to have to incur some debt to finance it. So now, rate of return on invested capital, those things are playing a bigger role in dealer buyers' minds. So the values are coming down a little bit, but we also hear from dealer groups is that many of the risks that existed 4 or 5 years ago seem to have gone, dissipated. Subscription, Uber is not going to replace private vehicle ownership.
So the landscape has changed as well.
Yeah, we've been through a global pandemic and dealers got wealthy. So it seems to be a business. I mean, we joke about it. Auto retail is kind of the cockroach of any retail business. Like it's almost impossible to kill. So I think the level of confidence that exists amongst dealership owners is very high relative to the risks they see. And they don't know a better place to invest their capital than in another dealership. It's not to say that every acquisition is a winner. We're divesting stores for medium and large and publicly traded companies where they bought something and it hasn't worked out the way they expected, so they're going to sell it. They got some winners, they got some, so-so, and they got some losers. That's part of the M&A activity I mentioned earlier we're seeing is the level of divestiture activity has skyrocketed, where 3 years ago, no one wanted to sell anything if you wanted to grow. You kept everything you owned.
People are cleaning house.
They're cleaning house. That's a good way to say it. They're tidying up and realizing this is not an asset that's working for me. I'm going to sell it, take my capital out of that, and deploy it into an area where I can get a better return.
Yeah, that's interesting. I think that when you think about, there's a saying, every problem is a people problem. And so when you say these divestiture, I go back to, what I mentioned earlier about the pandemic cohort of hires, but just thinking through, right? Like now things are being exposed. We're in a market where, it's all about the fundamentals, those principles. And so things are being exposed and, people need to make the right changes. Talk to me a little bit about valuations. So a bit of a different question. I read recently, there was an article in Automotive News about Dave Canton Group in the industry working on AI-based dealership valuations. I don't think we've talked much about this in the past. Maybe we've talked a little bit about how you value dealerships, but the specifics. But I'm curious to know, as I'm sure you know about this and I've heard about this, I'm curious to know what's your take on it, on just valuing a dealership, leveraging AI in that subjectivity, objectivity. What's your take?
So we spend a lot of time at valuations. Before we're hired, we usually give a potential client a valuation of his or her business to give them a good idea of what they can expect if they go to market. If they want a value that's twice what we think, then we probably won't take the assignment because it's unlikely to be successful. And we'll tell them, we'll say, if you want that number, then we think your earnings need to change, or you have to solve these problems over here that buyers are going to object to. So to come up with value, there are, I don't even know how many factors involved, dozens. And many of those factors are based upon what we've seen in our history of selling dealerships in the past. So this year we're going to sell around 60 dealerships. So that informs the values that we provide to our potential clients. But there's no public database of transaction data. How much was a store making? What did it sell for? What was the real estate worth? What was the economy like? What was the competition like? What was the facility like? These are all things that drive value. And as I understand AI models, they depend upon, must have a massive amount of data to feed to them so that they can crunch that data and come up with recommendations that, and so if you don't have any good data going in, how will you get good data coming out? So it's a mystery to me how AI will come up with valuations of dealerships. And I look back at our own history in terms of how accurate we've been in valuing stores over time. We did this a couple of years ago because somebody asked us, well, how do you know your numbers are right? You're just saying this. So we wanted to go back and check, well, how right have we been? And we went back and looked, and the values that we estimated to our potential clients, what we thought they would get versus what they accepted. In 2019, the blue sky value that they accepted was 98% of the mid-range that we gave them. So we said, hey, your store's worth, 10 to 12 million. They were selling for 98% of $11 million. So we felt pretty good. Hey, in 2019, we knew what we were doing. We were very accurate. Now, some were high, some were low, but on average, 98% of the midpoint of the range. Then the pandemic hit, and buyers got a little concerned the first few months. Sellers got a little afraid. So the stores that did trade in the first half of 2020 traded for less than what we had expected. So for the whole year, clients accepted offers that were worth 86% of the midpoint of our range. So COVID hit, and we had overvalued stores. We didn't know COVID was going to hit, and we gave the value, but nevertheless, we still did that math, and the market values came down a little bit. Then we continued to do evaluations in 2020 for clients that sold in 20 or 21. We started to miss it the wrong way. COVID was better, was going so well. Buyers were bidding more for stores. And so in 2021, our clients accepted offers that was 106% of the midpoint of the range we had estimated. In 22, it was 24% higher than the midpoint of the range. 23 was even worse. In a good way. They accepted offers that were 31% higher than the midpoint of our range. So COVID was happening so strong and so fast that it overwhelmed our internal ability to provide accurate values for our clients. Now, COVID's gone. It's in the rearview mirror. And now when we're valuing stores, if we looked at what our clients have accepted this year compared to what we estimated they would get, we're at 105%. So I share this because, we use AI in our business already, in our communications, some other areas and research. But in terms of having an AI model predict the value of a store, I think it's impossible. And I've had 2 dealer groups contact me who said they'd seen an AI tool and it wasn't even close, the value they predicted versus what they had paid. So far, I don't think AI is going to be able to replace our team in estimating value. And I really don't know how it will, because we're never going to publish the data that we have for, how stores trade and what they get paid for and what the variables are. There's just too many factors that go into that are all private. And so an AI model is never going to get that data unless all of us who sell stores contribute this data to some grand database. And we're all too competitive with each other to ever want to do that. So I think for evaluations, you're going to have to go to firms like ours that study this.
I appreciate your candor.
Yeah, because we're not always right either. I mean, I told you about where we're wrong, good and bad ways.
So tell me about just your outlook, right? I'm curious to know, how do you think about the rest of this year, more importantly, 2025, but give us a little sneak peek to what you're seeing on the horizon.
I think we're going to continue to see consolidation. I think, the public companies were really active in the first couple of years of the pandemic. They've slowed down as their earnings are declining. They're choosing to use their capital for stock repurchase, but eventually their earnings will level off and they'll begin to buy stores again, in my opinion. I think they're kind of waiting for values to settle. before they go on another more aggressive acquisition tear. But private dealership groups have got a lot of capital and a lot of confidence. Many of them, they've assembled management teams where they have a dealer principal, but then they'll have some professional operators below them. They've got professional CFO. They have centralized accounting. They have some specialists for for variable ops, fixed ops, marketing, IT, HR. So they're able to have a pretty good sized business and then tuck these stores in, reduce some costs and boost some performance. It's not, consolidation in our industry has been slow because there are not that many economies of scale. And the biggest determinant of success remains the quality of the manager in that chair, whether you're a private dealer or a public company. And it's not easy to find talented people, and it's not easy to create that talent. It takes years or decades of experience. So I think that talented groups that can attract and retain capital are going to continue to grow. And I think that we'll continue to see people who are aging decide, hey, I'm going to sell my business because it's still worth twice the amount of blue sky that it was before. So I think M&A activity is going to remain high. We have some nice tailwinds coming towards us in terms of declining interest rates and hopefully rising sales. Sometimes it's going the other way around. Like, you cut sales to stimulate demand, right? We've already got decent sales, but I'm hoping that a little lower rates will result in higher sales because we need that. We're way below the number of units operation in this country has fallen significantly. We have to get back to where we're selling 17, 18, 19 million units a year to catch up on this deficit we have of vehicles in this country.
Do you think though? Do you think that would be healthy for the industry if we got back to those levels? I mean, we are right now like 10% or maybe even a little bit less below, sort of 2019 levels on the new car side. 17 plus million down to about 15.9 or so projection. Do you think getting up that high is going to be a healthy thing for the industry?
I think that we need to catch up a little bit. We had a deficit of sales from 2020 through 2023, right? Where we're selling below 15 million units a year. We're selling 12, 13. So there's been a gap. And so that's put pressure on the used car market. It's been hard on consumers. There's a lot of debt that consumers took out. There's a lot of negative equity now. But I think that there will be a time to catch that up. And remember, we also have more people in this country, Yossi. This is 2019 now. It's 5 years ago, right? So we've had, real population growth, whether it was desired or not. We've got millions of more people in this country that are going to buy cars. And so they need transportation to get to their school. So that's one of the wonderful things about the United States. We're a growing economy. We have more people that need more goods and services. So for us to sell the same number of cars that we sold from 2014 through 2019, or fewer. Thank you. Fewer. It's 2 million. I think we're about 15 million, 15.5 million now. It used to be 17 million. So will dealer profits come down a little bit if we have lower gross profits per new unit? Yes. But if we are selling more cars, will we have more cars to repair in the future? Yes. Will we have more trade-ins in the future? Yes. Will we have more cars to finance and insure? Yes. So I feel like we need some more volume in our business to remain healthy over the long term. And the consumers need it, right? I mean, a lot of us are driving cars that are, I think the average age is now 11, 12 years old. That's the highest it's ever been.
Alan Haig, always a pleasure. Give us a couple of predictions to end off the podcast. What's going through your head nowadays? There has to be something that we didn't talk about that you're thinking about.
I think that in many ways, the best years of our industry are still in front of us. That the pandemic, I think, has proven to many people that this business is extremely desirable. I think that the public companies and the Carvanas of the world are demonstrating a higher level of professionalism in many cases, a higher level of technology, a higher level to what consumers want. They're providing that, and other franchise dealers can copy it, can adopt it, and deploy it in their own.
It's definitely been just I would say a positive for the entire industry because it's pushed others to be better.
Yes. And I think that technology, and I mentioned AI, I think AI could have tremendous advantages for auto retailers in terms of reducing expenses, better serving customers, eliminating inefficiencies, because there's a lot of time and money spent on no sales in the car business. Let's get rid of that. Let's satisfy that demand faster. That's what the customer wants, less expensively. There have also been big shifts in market share during the pandemic. So it's kind of a sleeper franchise that we've been talking about for the past 12, 18 months is Mazda. The average sales per location for Mazda has just boomed. Their sales have increased about 48% in general, and their dealership count has gone down. And they don't yet have hybrids. So to me, that was a brand that nobody really wanted a couple of years ago. It was kind of, you bought it if you wanted a starter store, or if it came along with a larger group, or somebody would buy it, put it in a used car building. But it's now at the level of sales where I think it's becoming competitive with Kia and Hyundai in terms of sales per location.
I was going to say, I just posted about the Mazda sales. So in October, Mazda was the biggest winner out of any brand in terms of year-over-year sales growth. 59%, right? Second best was Hyundai Kia at 17%. That's just, it's mind-boggling. And again, obviously different baselines, but I mean, it's clear that, they're growing. They're doing something right.
Yes, so they have a more desirable product. And I think a big game changer for them is that Toyota has invested in Mazda and is now providing financial services through TFS to Mazda customers. They designed a vehicle together. They're producing in the United States. There's going to be a Mazda version and a Toyota version. So if you have Toyota as a big brother, to me, that provides a lot of comfort in the long-term viability of that franchise. And then I think another thing that I hope for, that I think will be good for dealers in this country, is I'm hoping that we may see a merger between Nissan and Honda. Just like there's kind of a tie-up between Hyundai and Kia, where together they were able to design and engineer and market more desirable products than they were independently. Together they can afford all the costs of developing these vehicles and share it across two brands. I feel like Nissan certainly would benefit from an engineering partner, and Honda itself is not big enough to compete with Toyota or the Koreans. So the combination of those two, and they can differentiate the product. Maybe Honda is a little bit more mid-level upscale, and maybe Nissan is more trucks and SUVs and affordable type vehicles. They can differentiate that somehow. But I think that if we saw a merger there, we would improve the long-term viability of Nissan dealerships and Honda dealerships. Honda's doing great today. They've got hybrids, they got great product, but they've got to compete long-term with Toyota and with the Koreans, and that is not easy. So that's a prediction that more people want to buy Mazda stores, and it's a hope that I think it's going to take the Japanese government probably to put those two companies together, but hopefully they'll see that and want to do it.
Alan Haig, always a pleasure catching up with you. We're going to, like I said earlier, we're going to link the Haig report below in the show notes. So anyone that wants to dig deeper into the insights, they can just download the report and read it all there. Or of course, they can reach out to you as well directly, Haig Partners. Alan, appreciate you coming on. Always really enjoy going through the latest and greatest.
I'll look forward to your next podcast, Yossi. Thanks for having me on.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.